Good morning, Jags. Today is Thursday, October 8th. I have Chronicle here with me. Hi, Chronicle.
Morning, Fahad.
Um, Today is an interesting day because I'm excited about what we are starting in Jaguar Media. This is a brand new series. And those who are familiar with the Jaguar Media video productions that we have been doing for several months now, aside from the morning conversations that we do, a couple months ago, we started a brand new series called Chinese Tech Demystified, and we produced 5 different videos covering 5 different stocks for that series. Today, we are starting a brand new series called Jaguar Investing Series. And the very first stock that we're going to cover here for this series is called Xpel Incorporated, symbol XPEL. An interesting pick and under the radar high growth name. So let's get started. Chronicle, tell me about it.
Sure. So if you've been following our morning conversations, you know that we like this company as an active long idea. And so in this video, as well as my research note that's attached in the link below, we're going to explain why we are actively long this stock for the next 2 to 3 years. Obviously, this video is not going to be long enough to cover everything. Otherwise, we're just going to bore a lot of people to death. But when it comes to the attached note, that's where I covered the company from every angle, from basic information right down to management philosophy, as well as my financial projections over the next 3 years. Um, all right, so without wasting
So
time, let's
just to be clear to all the audience, so the differentiating part about the Jaguar investing series is that the stocks that we will cover here are going to be longer term horizon in terms of owning the shares and then seeing the cycle play out in the favor of these companies. It's not a quarter or 2 quarter event, but potentially 1 to 2 year holding period. Is that correct?
So we've gotten feedback over the months about, are there any longer term ideas? Are there any buy and hold ideas? So we thought we'd just create a new series where we basically compartmentalize all these ideas, which have a longer term horizon to complement all the shorter term swing trades that we're more used to.
Excellent. All right. So tell me about XPEL.
Sure. I could go on about this company all day, but I guess the simplest definition would be that Xpel is a provider of automotive paint protection films, or PPF in short, and window films. So on the next slide, we can see that these films help to protect vehicles from all sorts of scratches and stains. Sorry, the next one. And they're also self-healing. I would totally recommend this for anyone's car. They also provide a subscription software that aids in the accurate cutting and templating of these automotive films, which also reduces waste. And recently, the company has also expanded into selling ceramic coating, commercial and residential films, and antimicrobial film. That's now a growing part of the business. Now, all of this stuff isn't DIY, and so the company sells them primarily to automotive dealers and installers and workshops, all these sorts of locations. And the way the company markets all of this is by leading in with the software, which is the unique selling point, and offering hands-on training. Once these dealers acquire the software, that's when Xpel begins selling them the films. And the beautiful thing about this is that these dealers and workshops are the ones that do most of the marketing for Xpel, because a full car body wrap can be priced anywhere between 4 to 5 grand. And so these dealers are highly incentivized to promote and market these films by themselves, because to them, it represents a high margin add-on opportunity on top of their services. So Xpel actually has a very low marketing cost, even though it's growing rapidly, and it also consistently reports positive profits and cash flow. That's a unique quality to have when it comes to high growth companies. So if anyone wants to know everything about this company, from the interesting history and the current leadership, plus the descriptions of each individual offering of Xpel, as well as the marketing strategy, management philosophy, market positioning, competition, and the Penske sponsorship, all of that is on pages 2 to 6 of my research note, because it's going to take too long to explain all this in this bite-sized video. So do give it a read.
This company's biggest competitor would naturally be seen as Eastman Chemical, that provides a lot of coating in the paint business to the automotive sector. But you have it clearly stating over here in your write-up that Eastman Chemical is growing at 3% year over year, while this company is growing at 20% year over year in its coating film business. What would you say is the number one reason how this company has been able to differentiate itself and maintain a growth rate that is so substantial, almost 7 times faster than the biggest competitor that's out there?
I would say the number one reason is that these companies are positioned differently. So Lumar and Suntac under Eastman, they don't have specific target customers, and their films are marketed to the general population. Xpel, meanwhile, has built this coolness factor by targeting high-end luxury and sports vehicles over the years. So that adds to revenue growth incrementally. The other thing I would say is that films are not a priority for Eastman, and as a result, they don't. This part of their business doesn't see much investment, and even if you were to look at their conference call, it usually only gets mentioned in passing.
Very interesting stuff. And looking at their financials, these are some just fabulous charts. And frankly, they were quite eye-popping to me when I was looking at the trajectory of the historical 5 to 6 year growth rate for the top line revenues. And it's not just the United States, it's actually across the board in many regions. Revenue rate used to be in 2017 just above $60 million per year, and they doubled that in the matter of 2 years, with 2019 revenues reaching $130 million. And with the kind of growth rate that is expected from this point on, even if the automotive cycle goes through some lumpiness, with the market share gains and the growth rate so much materially above the industry average, they can continue to, see the growth rate that's quite strong for many more years to come. Cash balances on the balance sheet has also increased sharply. Earnings per share is there to see as well, with the second quarter trailing 12-month EPS coming in at 55 cents, roughly, give or take a few pennies. So these are pretty strong trends.
Yeah, so Xpel has seen tremendous growth since it expanded globally and introduced new products to its offerings. Currently, I'd say the fastest regions for growth are Asia, China, and Europe. In fact, Chinese sales in Q2 managed to triple despite the pandemic. China is seeing fast adoption because of its harsh environment and air pollution. Europe, meanwhile, saw nearly 50% growth in Q2 as well. In North America and Europe, Xpel is particularly popular with sports car enthusiasts and EV owners. Tesla owners have especially taken a liking to Xpel's films for whatever reason, and the company has responded to that demand by offering pre-cuts for all Tesla models. So Xpel has sort of built a coolness factor with its brand image here, and their sponsorship of Team Penske and racing events has also helped to build awareness. Now, if you look elsewhere, Canada is also expected to contribute meaningfully after this pandemic goes away. Xpel acquired Protex Canada in February, just before COVID-19 hit, and they're running a franchisee model over there. I think Canada has good growth potential because Xpel's films can help protect vehicles from winter-related damage and road salt, which makes the demand there a bit less discretionary. Now, on this slide, one of the things I like most about Xpel is its profitability and efficiency. From the graph on the top right, we can see that the company has managed to widen the gap between revenue and cost of revenue, which I have included distribution and marketing costs in the calculation. Apart from economies of scale, there are a couple reasons for this. First off, Xpel enjoys tremendous pricing power because of its coolness factor and brand image. This allows the company to mark up the prices of its films to luxury and sports car owners and dealers. Additionally, if customers only want the films on specific parts of the car, the profit margin becomes even higher because if we think about the royalty and the per cut fees that Xpel charges, like for example, in the US, the package which offers full body protection is typically around 4.5 grand. but the package which offers only partial front hood and fender protection is priced at $700, so the margin is higher. Now, the second reason for high profitability is the company's low-cost marketing and expansion strategy. So as I mentioned earlier, Xpel doesn't sell directly to customers, and so they have to go down the costly route. They don't have to go down the costly route of marketing directly to them. So it's actually the dealers and installers who do the promoting. Meanwhile, if we're talking internationally, I think Xpel is sort of like McDonald's or Starbucks in the sense that the company doesn't try to micromanage or build operations from scratch, but it leans on the local and cultural expertise of each of its distributors in each country. This saves the company a lot of cost and headache. And finally, if we turn our attentions to the operational efficiency graph on the left, this company has 34% return on assets, 50% return on equity, 44% return on invested capital. Fahad, can you name another company that's in the automotive space that has this much managerial efficiency?
No, I cannot. And I was just about to make a comment on this because it is very rare, especially for small cap companies. I believe this company is about $800 million in market cap, to not be able to just grow the top line at 6 to 7 times the industry growth. But on top of it, see the kind of margin expansion that this company has shown with the free cash flow generation at the same time. I mean, clearly they are emerging as a very, very strong leader over here. I was just looking at some of the other graphs that you have on your write-up. The operating margin was only 3% roughly in 2017. But after that lawsuit was settled with 3M in 2017, this company has increased that margin by 1,000 basis point from 3% to 13%. In this industry, this is very, very strong margins. And on top of it, they have been able to do that by while keeping the debt to equity ratio on the balance sheet to bare minimum. So this company is operating financially very, very strong with the rise in operating margins, the top line growth revenue is remaining extremely strong, market share gains and everything. And I think it's just a beautiful picture emerges if somebody basically simply pulls up their financial statements and goes through all of them. So really impressive picture. Now going on to your next slide, you have built your own projections model over here as to what the future will look like, 2020 estimate, and then going all the way out to 2023. Now, you're very positive at this name because looking at your own estimate and applying a very reasonable, conservative multiple assumptions and the top line growth much below than what the company has been reporting, you come up with a price target all the way to $62 per share by 2023. I mean, consider that right now the stock is trading at about, where is it at? Around 25, $26 per share. So we're looking at 150% gain in the position in the course of next 2 to 3 years. Tell me, these assumptions that you have in front of you, what would be the one or two major key points that we need to keep in mind?
So this is all detailed on pages 10 to 12 of my note. Um, these are my most conservative projections for the next 3 years. Like you can see, I've used extremely conservative points here, like no improvement in gross margin, only slight improvement in operating margin, remainder of this year's sales below guidance, $400,000 of annual interest expense, even though management doesn't like to take on debt. I'm also assuming some issuance, even though management rarely dilutes, as well as no improvement in price to sales. On top of that, a 28% corporate income tax rate. Even with these handicaps, I expect earnings per share to roughly triple, and I think the stock can get to at least 60, as you've said. On top line, I'm expecting revenue to eventually exceed 350 million, and I also detail why on pages 10 to 12. But if I were to summarize the rationale, it comes down to 3 points. I think 2021 and 2022 are going to be breakout years for international sales. There's the growing demand and adoption, but on top of that, based on conference call comments, it sounds like management is starting to get the hang of perfecting inventory management in international markets. It's worth to note that a lot of Xpel's customers are running on a just-in-time system. Secondly, there's going to be increased adoption of Xpel's ceramic coating and non-automotive offerings. The latest commentary on those fronts have been encouraging, so it'll be interesting to see where they go with this. The total market size for these solutions are huge. We're talking close to $10 billion. Lastly,
Yeah.
there's the potential hidden catalyst with regards to Xpel sponsorship with Team Penske and open world racing events. The entire Penske organization runs thousands of dealerships and leasing locations across the US and globally. So if Penske ever decides to strike a film partnership with Xpel, that would be a massive windfall.
To your point about company expanding its reach into non-automotive segments, there's a very important comment here that I would like to bring up because the discussion here on this slide is more long-term, right? But it's important to understand that it's not just automotive. Within the non-automotive applications such as manufacturing, healthcare, and aerospace, the company has a key product called Fusion Ceramic Coating Product. And here's a comment that comes directly from the management in which they said, our Fusion ceramic coating products also hit record sales in June and then again in July as we see increased adoption. We have product line extensions planned here for Fusion that will be released soon. And so we'll be talking more about that as well in the future. This is, I believe this comment came out from the last earnings call from the company, which was in August, giving us a clue that June and July both were record months for the non-automotive applications. And the extensions of this product, which are being released right now, all of this is very positive for the next earnings report that will be coming out pretty soon as well. So to your point about that 2021, 2022 will be a potential breakout years for this company internationally and domestically. I think the next 1 to 2 quarter could potentially give us much better, cleaner view as to the direction of the company. So very, very impressive comments, very strong comments from the company based on the non-automotive segment as well. Moving on to the bottom line of this investment idea, and now you have me very excited with all this discussion. What are your final thoughts on this?
Sure. So number one, Xpel is well run by people who truly love the company. If you look at the research note, the CEO, the current one, was willing to put his own money on the line when the company almost went bust because of the GFC, because he believed in the company's potential. And even though this is a public company, the internal culture has sort of a small town family feel to it. Number two, Xpel has barely scratched the surface in terms of market penetration domestically and globally. They've gained a cult following amongst luxury and sports car and electric vehicle owners. And I think this coolness factor is going to serve them well as they market to non-luxury dealers. And as we touched on, we expect the next couple of years to see strong growth from China, Asia, Pacific, Europe, and Canada. Management commentary on Mexico is also encouraging. Number three, Xpel's new ceramic coatings and non-automotive offerings, as we said, are another avenue of growth. Number four, this is a high margin business. They have this unique ability to grow rapidly without ramping expenses because their dealership and installer customers are all incentivized to do all the marketing and promoting. Number five, insiders own more than a third of the company and share dilution is rare. The last time it happened was a $2.6 million issuance in 2017 to help fund legal costs for the 3M lawsuit. Insiders have been selling some shares recently, but it's nothing worrying. Lastly, number six, Xpel's sponsorship of Team Penske might lead to a highly lucrative partnership with Penske dealerships and leasing locations globally. This is something to keep an eye out for.
How big is that sponsorship, and when did it kick in?
So the sponsorship started in late 2019. It's an IndyCar sponsorship, which is an open road circuit. So a lot of a cult following.
Yeah, absolutely. So that's probably something every time when somebody does partnership, it takes times to materialize. I think that's probably going to kick into high gear probably around this time. It's been a year into that partnership. So that should become another strong positive catalyst going forward from here. Great stuff. This was impressive. I'm excited about this opportunity because I love the companies with high margin business, market share leaders, growing at a rate that is multiples higher. In this case, 6 to 7 times higher than the industry growth. Maybe becomes an M&A target in the future as well. Almost no debt on the balance sheet, strong management. I mean, what's not to like over here? So I think this is a fantastic presentation for a good long-term buy and hold. Thank you very much for joining. Thanks for this presentation, Chronicle, and we will see you again next time.